early, so I do appreciate you taking the time out of your Wednesday nights and sparing me the 5 minutes while I just wrangled with Canva. Normally, Canva is oh so reliable, but not tonight. I was having a few issues, a few headaches. So I can see a few folks have already commented. Mike, good to see you again. Martin, Benny, who else we got here? Caroline, MLS. Thank you so much, everyone, for taking the time out of your Wednesday night. We are starting something very special tonight. We've got the first of 4 sessions with the team at Betashares. We'll be going through the next month talking about everything from like the new thematics and things that you should be mindful of, whether it's artificial intelligence, food, agriculture. We'll be talking about all of that. We'll be talking about how you can invest when there's so much uncertainty in the economy and how you can use ETFs to do that. We'll be joined by Ali tonight from Betashares, and she'll take us through a bit of her journey and the rise of Betashares. Because many of you, in fact, I'd imagine all of you know of Betashares or maybe even invest in one of the ETFs that they offer. So we'll be talking to her about kind of the rise of Betashares, the rise of ETFs, and so on. But you'll be especially pleased tonight because we do have 2 disclaimers for you. In fact, maybe even 3 disclaimers. So I know, like, when Rob sent me a message this morning, as he usually does on a Wednesday morning, he said, cannot wait, particularly if there's going to be a triple treat in terms of disclaimers tonight. But of course, we will start this week with a joke. And I went to a new restaurant today called Karma, and there was no menu. You just get what you deserve. And I think that's a great thing, isn't it? I always think when I go to a restaurant, can't they just choose for me? I know there's like those degustation menus, but like seriously, can't you just like fill in like 3 check boxes and be like, give me the best you got? Because like it's analysis paralysis for me. Give me a stock or an ETF any day of the week. I'm happy to choose between them. But when it comes to food, there's not enough room up in my memory palace for all of the different cuisines and things there. So a very important announcement from Selfwealth. You can see it right here on the screen in front of you. There's a big finger pointing to something, and those words look like they say subscribe. It's not orange when you hit subscribe on the YouTube channel. It's actually, I think it may be red or grey or something like this. Is it just dessert, says Stuart? Maybe. It probably should have. This is from Dad Says Jokes, that joke. So maybe I'll take it up with them. I'll send them a letter in the mail. But thank you for that. And I can see it's a 10 out of 10, says Chef Circle, naturally. So thank you for that. So a bit of a disclaimer. We've got the invisible legs going on again this week. Self-Wealth Live videos contain general financial advice only. That means the information has not taken into account your needs, goals, or objectives, so you should not act on the information until you have spoken to a licensed and trusted financial planner. I'm the founder and sole director of the Rask Group, and we are a corporate authorised representative, number 1280930 of Wattle Partners AFSL 383169. We do have a financial services guide. It's called an FSG, and every advice giver has one of these in Australia. You'll find them on their website, and they tell you everything you need to know about what advice we can and can't do. So you can go and check that out in your own time. It's great midnight reading if you want to go to sleep. And the final thing is the views expressed in the live streams are solely those of myself and or our guests. We do have a very special guest with us tonight, and they do not necessarily reflect the views or opinions of Selfwealth. Now, I did promise you 2 extra disclaimers. These disclaimers are also available in the description. So everyone reads the YouTube description, so it's in there. It's down the bottom there. You can see a lovely disclaimer from Selfwealth and another from Betashares. I don't think I've had the honor or the joy of being surrounded by 3 AFSL numbers, but here we are. So it's a bit of fun, but it's also serious because we don't know your personal circumstances, and particularly when we talk about things like ETFs, it's really important that you remember that you can find out the essential information by reading the product disclosure statement. The product disclosure statement for the Betashares ETFs are available on the Betashares website, which I'm sure we'll reference at least once or twice throughout tonight's show. Okay, so for tonight, we have a very special guest. I was trying to think back to myself off air. I was like, when did I first hear her talk? And I would guess that it would have been 5+ years ago. But Ellie, welcome to Self-Wealth
Hi.
Live. It is my pleasure to have you with us.
Pleasure to be on and pleasure to be chatting again. As you said, it's been quite a number of years, I think, since we've connected. So great to be on the show.
Yes, you're joining us from Sydney, from Betashares HQ.
Sure am.
We're going to talk a little bit about your journey and a little bit about ETFs in the market overall, because it has literally taken the investing world by storm. And you've kind of had a front row seat to all of this here in Australia because you've been working with Betashares for such a long time.
Mm.
But maybe just to set the scene, this is the first installment of a 4-part series. We're going to be talking about ETFs. Let's start with, what is an ETF? Just for those people that may be completely new to this topic, even though so many of us have been investing for quite a while.
First question, hopefully I can answer it. You're bang on. So I'll go back to Betashares. So Betashares is we're a leading Australian ETF manager. Started in 2010, and I've been with the business for 7 years. So definitely been fortunate enough to be part of the growth story here, and it's been an incredible ride. But for those not fully across what an ETF is, it's another acronym. I know there are quite a few in finance, but it stands for Exchange Traded Fund. And that essentially means you have an investment fund, made up of a portfolio of securities, companies, stocks, and the like. That's then packaged up in an investment fund, and then it trades on the ASX. So you can access ETFs in the same way that you would buy a stock, such as Woolworths or BHP, using a broker such as Selfwealth. And that's the benefits. You've got the diversification of a managed fund, yet the access benefits of a stock. And so they've been growing rapidly in popularity, and Betashares has been a huge part of that story.
Yeah, it has indeed. Can you maybe talk us through this a little bit? For most investors who just buy or sell ETFs, probably aren't aware of like the big picture and the kind of the landscape that's forming around this industry. But as far as I know, I believe, I could be mistaken, that Betashares has risen to be the second largest provider by total dollar value invested. And you've, like I said, you've kind of been there for such a long time, and you've been helping people understand ETFs in the market. Can you give us a sense of Betashares' journey in the industry, and then maybe also why you think, other than what you just mentioned, why you think ETFs in particular have taken off the way they have?
Yeah, great question. So we'll start off with the Betashares side of things. So yes, started back in 2010, and it's still run and managed by the Australian management team today. So we really had that continued local focus in the market, and that was really pivotal to the success. Rather than being a kind of global orientated firm that had an Australian presence, it's like value proposition was really building funds for Australian investors, and we have never lost sight of that. So that's been part of that journey. And you're bang on, we're the second largest provider in Australia by inflow, and nearing 30 billion of assets under management. There's a great screen grab of our newish website, so which we launched earlier this year, but it's super intuitive and it's good. And we also have the largest range of exchange traded funds on the market. So we're over 80 funds now. So essentially, almost a one-stop shop there for investors.
I've got to admit, this new page, I was only checking this out yesterday, is actually really cool. It's really helpful for a lot of investors that just simply want to put two ETFs side by side and compare them. Like we've been calling out for that for ages. So it definitely makes it easier for people to compare, because there are over, I think it's over 200 now. So
336.
336.
336 as at end of June. So there might, be some more, but there's a lot. There's a lot. It's like a supermarket now.
Yeah, it is. It is indeed, right? Like it's become, and following the lead of probably the US, like there are so many things to choose from.
So many.
And they're, in my opinion, they're so great from the perspective of transparency, typically a lot lower fees than you get for other types of investments. It's easier to access markets that might otherwise have been pretty hard to access. So there's so much opportunity for ETFs to be those building blocks in a portfolio. I've got a few questions, but one of them is kind of more pointed, because we're in August. We did a session maybe 2 or 3 weeks ago where we talked about end of financial year means end of tax year for Aussies, and the process behind what actually happens now, or maybe a few weeks ago, for people that invest in ETFs. How can they go about thinking about, from like a tax or admin, just purely an admin perspective, what they need to do?
Yeah. An awesome topic to touch on. And this is a complete geek moment, but honestly, this area is one of my most passionate areas of investing. It is around the tax side and also the administration of your investment portfolio in general. it seems to be when people make an investment in any type of, the company, ETF, whatever it is, they kind of think their journey stops once they get the trade confirmation or trade note from the broker. But there's a whole bunch of other things that kind of go on in the background that investors, need to be aware of as well. And that really comes to a head, I suppose, at end of financial year when you're like, oh my gosh, I have to do my tax return. Where are my distribution statements? What do I do? And so the first step really is to go to something called a unit register. So every ETF manager in Australia has one. Our one's Link Market Services. So if you are invested in a Betashares ETF, go to Link Market Services and register your portfolio with them and provide your email address to them. That then will give you access to your distribution statements. You can put in your tax file number, set your dividend reinvestment plan preferences, and a whole bunch of other cool stuff, like your bank account, for example. So you actually get paid your distributions, always good. So that's kind of step one. And so you've got all your admin function kind of ticked off once you go to the unit register. So once you've completed that, that's more of an always on kind of admin function, I suppose, for your portfolio. Then at tax time, what happens is we actually provide all of the information that you need to do your tax return to the ATO, and that should be pushed through automatically for you. If you log onto the ATO and you don't see your information regarding your ETF holdings from the manager, give us a call because it should really be there. So we do try and automate most of that process for you because it's very important to actually record your, say, your kind of tax implications around investing.
For sure. Oh, it's so important. I think you're totally right. Like, it's not just ETFs, it's any type of investing.
Yeah.
People just think, okay, I've done it now. Like, I can wash my hands of that. But like, every year, it does get a little bit more complicated than if you're just a salary PAYG employee.
Yeah.
And so these things have to be taken into account.
Yeah.
We've even had folks on the show talk about like portfolio tracking software and these types of things that can help them with the admin side. And I think, to be honest, anything that makes it simple, and I think your description there of like the pre-fill and ATO is so helpful. I think another really good thing is, like you said, at the unit registry, is just to set your email preferences rather than get those things in the mail. Gosh, they're so frustrating.
I mean, you'll still get chess statements in the mail. It's kind of like that Harry Potter episode, all the letters kind of coming at you, but it is something that's involved with investing at this stage. But any kind of reduction in paper is a good thing. So please give your email address.
For sure. So a lot of the times we come on these types of shows and we talk about like investing at large or investing in ETFs or funds or whatever. And we don't often get like the human element behind it. So one of the questions I was curious to ask you is like, you've been in the ETF industry for a long time. So I'm guessing you invest in ETFs. Yes, that's fair to say. Okay. Do you invest in anything outside of ETFs?
Great question. So I had a pretty haphazard start to my investing journey, if I'm being honest. This was before I had any awareness of ETFs. So I didn't actually know about exchange traded funds until I started at Betashares all those years ago. And I started off my investing journey investing in stocks and gold, like physical gold, like went to the gold mint, bought a lump of gold, took it home anyway. And, picking single companies didn't work out that well for me. I didn't educate myself enough. I probably, picked up too many tips at barbecues and kind of hearsay and things like that. And so it didn't really result in what I wanted, which was obviously, a profitable portfolio. And it kind of scared me off investing. And this would have been probably early 20s. Maybe a bit before then. And so I kind of, stayed out of the market for a long time and then started learning about exchange traded funds, obviously, as part of my role here, and just realized it was so aligned to my investment strategy, which is, long-term buy and hold, pushes diversification, obviously super cost effective as well. So I now predominantly invest in ETFs. I think I have one company left in my portfolio, mainly because I want to be able to invest in something that I understand and I don't want to be checking it every day. I reinvest all my dividends and I just kind of put it in the bottom drawer and we'll look at it when I'm a bit older.
I think like your story, not to take anything away from you, is so familiar to many people. The idea of picking individual stocks when you're maybe not 100%, 110% committed to understanding the craft of individual stock picking is so similar to a lot of people. And it shows that, it's a very hard thing to do. And so using ETFs, if only for, I always say, for only the plan B, right? Like just to have some exposure to ETFs is so important because it takes away the stress of having all the other stuff that you really don't know much
Yeah.
about. And I can see that in our, we've done a poll here. Rob put up a poll earlier on and said, what is your portfolio split of ETFs to single stocks?
Mm.
And the most, it looks like, yeah, it is the most common answer from the Selfwealth Live community is 80% ETFs. And that's
Oh,
36% of
round of
people. So that,
applause.
yeah, it's true, right? It's
Very
worked.
good, very good.
It's
See?
worked. But I'm still coming across, and the second most is people that don't use a lot of
Mm.
ETFs, so
Mm.
20% or less. And I'm coming across a lot of people now in my journey, Ellie, who are like maybe it's 20 or 30 years into their investing
Mm.
journey, and now they're picking up ETFs,
Yeah, yeah.
which is a great thing. So it's never too late to adopt the new innovative thing, I guess.
Yeah, exactly. And whilst, they have been around for a significant period of time, there's 150 billion invested in Australia alone in the ETF category. It doesn't go back as long as someone investing in a company for the first time. So there is still a lot of education requirements going on, particularly with retail investors too, who may have, started, as you were saying, their whole journey for 20, 30 years around investing has been unlisted managed funds, or it's been, picking shares. And then suddenly this, product that offers kind of the best of both of those worlds comes to market, and the journey and the industry is growing really quickly, but there's so much growth to go, and that's why we really put a big focus on education as well, just to really empower people to actually understand what this investment product can do for them.
Yeah, for sure. One of the things that then comes to mind naturally is like, how do you go about picking ETFs? And we'll be talking in upcoming episodes or installments about how that you can actually think about that. But just, I'm curious from your perspective, what are some of the key characteristics you look for, the key factors that you consider?
Yeah, no, it's a great question as well. So, I mean, I invest in a number of different ETFs, and every time I look at them, there's probably a different driver of decision making that I do. But broadly speaking, because I, for lack of a better word, can't be bothered picking single stocks, with ETFs, it helps me invest at a theme level or a topic level that I understand. So, for example, technology. I fundamentally believe technology will forever be a part of our world. I don't feel like technology as an industry is going anywhere. Therefore, an ETF that provides exposure to technology and the growth of technology as part of our everyday life is very appealing. So we have our NASDAQ 100 ETF, which is one of our most popular kind of core orientated funds,
NDQ,
which provides exposure to the top 100, companies on the NASDAQ 100, which includes, Facebook, Apple, Google, all those names that are just part of our lives. I'm not sitting there saying, hey, I want to invest in Facebook or Microsoft or Apple. I'm just saying I want exposure to technology. And so by way of that really helps me, kind of drive the decision to use an ETF to get that exposure versus going down that single company route.
For sure. And I think you're right. Like the way I think about it is there's almost like two different lenses. There's like the core portfolio holdings, and then there might be like sector based or thematic based over here. And they kind of require two different things because for me, at least, on one side, I'm happy to have a little bit more, fee budget, so to speak, pay a little bit more in fees to have that thematic or sector-based exposure. But in the core, I want a super low cost, right?
Yeah.
And that's probably an example of an ETF that could fit in both, to be honest,
Exactly.
at least from where I sit. Okay, so I've got two more of my own questions, and then we'll probably have time, just looking at the time, probably time for a couple of questions from the audience. So guys, gals, if you're listening, watching, please chuck your questions in the chat,
Get
and
your questions in.
I'll chuck it through to Ellie here. So the first one is like, some people don't invest a lot in ETFs. It's fair to say some people are maybe resistive of them for whatever reason, which is fine. What else? Like, what do you think causes some of the roadblocks for people to start using ETFs, whether it's for the first time or whether it's to keep using them? Like, are there any things that keep popping up for you?
So from a first-time investor perspective, as we say, like everything we do is essentially driven by emotion. A lot of the time it's fear, and it's a bit of, paralysis analysis, I suppose. And it's just not knowing where to start. We said that there are over 300 ETFs on the ASX. I mean, if you're looking at that for the first time as a first-time investor as well, not only are you worried about, where do I get my money from to invest or anything, you're looking at this whole range of exchange traded funds. They've all got different names, different things like, management fees that you have to start understanding different providers. So it is a bit of, it's an education journey, really. And often we hear from people just saying, I just don't really know what it is or how to use it. So it's really, I think taking the time and being patient with yourself to say, cool, I'm actually really going to educate myself on this product. And when you get your head around it, you realize that, oh, wow, this is actually a really simple, solid way to start an investment portfolio.
Yeah.
Education is key at really dropping those barriers, tuning into sessions like this. There's great chat rooms available. We have a ton of education content on our website too, which is free, which we offer to anyone. So you can go there and kind of sign up and browse around.
And then you guys have the ETF course, right? If I'm not mistaken.
Yeah, ETF course, and we send out weekly newsletters. So we really try and empower people through content. And then I suppose on the experienced investor side, where they might have, grown up with 10 stocks in their portfolio, it's just around, again, that education piece and just realizing that you can diversify really easily and really quickly, and you don't need to go down the whole older, traditional actively managed unlisted route where you're filling out tons of paperwork and, it takes a much longer period of time.
Yeah, for sure. So I've got one more from me, which is you guys, like you said, I think the biggest by number of ETFs released to the market and currently in the market. Can you just maybe just take a few moments and I'll look through the questions that we've got sent through. I can see a few already. Can you maybe just take a moment to talk to us about what actually goes into producing these for investors? Like, how does it actually end up in the Selfwealth account and we can invest it? Like, what goes into that process? And
such a good question. It's kind of like the behind the scenes of Betashares. Come on a journey, everyone. No. So what we do when we're thinking about a product to bring to market, we really go, okay, so what is out there? Where are the gaps? What could really fulfill a need for investors? Again, based on Australian investor needs, because we're a local company. And then we have multiple different stakeholders and departments across the business, including portfolio management, obviously legal and compliance considerations, and then external stakeholders, including the ASX, obviously brokers such as yourself, that all form part of that whole ecosystem to bring an ETF to life. So we think of the investment, product idea internally. It goes through a very rigorous process across multiple departments in the business, and then we go external with it, so registering it all through the regulatory channels. And then once that's all approved and we say, yep, great, this product is investment fit, for lack of a better word, then it starts trading on the ASX, and then people can access it through brokers.
Yeah. So it's like, I feel like this is like a multi-month process. It's not like you just can switch one on in like a week or something like that.
Yeah, exactly. And if there's if it's a product that might be less familiar in the market or something, it just goes through, honestly, the strictest process, because at the end of the day, it's, people's money. We take it unbelievably seriously. It's, people's nest egg, it's, a holiday, it's a house deposit, it's, any number of those things. So the process around ideation, product construction, all the way through to launch is extremely stringent.
I've got a bit of a fun one here, which you may or may not be able to answer on the fly. But it's from Paul. It's just around like, what are the ETFs that for like a core portfolio, or at least even just the sectors that are like your kind of like must-haves in a diversified portfolio?
Yeah. Great question. And I'll say this is general advice only as well. So
reminder, yes.
Come through to our site. But it's just around looking at what have you currently got in your portfolio and wondering where you need to diversify. So, I mean, if you are thinking about portfolio construction, obviously you would start leaning in towards things like, okay, so what are Australian companies are out there, and things like that would track the ASX 200 companies. Like, that is, it's not a hyper growth fund, but it's it's a steady ship. So we have the lowest cost Australian shares ETF in the market now. So we dropped our fees earlier this year down to 4 basis points, and that's Betashares A200 is the ticker. So those kind of well-diversified, equities orientated ETFs are, something to consider. And then you can look for other exposures such as technology. Then you can start thinking, okay, great, do I want now to add some thematics to that too? So you could look at cybersecurity or robotics and AI, and then suddenly you're building like so much diversification in your portfolio without having to, make a lot of trades as well.
That's a really good answer, by the way, and I really like that. Like, I consider obviously Aussie and global shares as like staples in every portfolio, regardless of whatever stage of life an investor might be in. But then there are other things like bonds or fixed income, which become increasingly important as
Yeah.
people get older and they seek to lower the risk of a portfolio. Okay, so I've got one extra. This is more like not an admin question, but like where do I actually find out this stuff? So Harpreet asked about where do you find like the performance and fees for an ETF? Like where can you go to get that type of information?
Yeah, great question. So you can go to the ETF manager's website. So obviously Betashares website, we have full product pages for every single one of our products. And on that page, you'll find pricing information, distribution frequency, the index that it's tracking, and very importantly, the PDS as well. So that's the product disclosure statement. So definitely familiarize yourself kind of inside out with how the product gains its exposure to whatever you're looking to invest in. And also has things like the management fees and performance information on it too. So that's kind of your go-to for everything that you might want to know about an ETF.
Well, I obviously that's the go-to source. So I don't think enough people read the PDS to actually determine what's inside the thing that they've invested
It's a
in
hefty
and how
document.
it's
It's
built.
probably good. Yeah, it's a hefty document, but it's a complete rundown of everything that you might ever need to know about the product. So definitely worth reading.
Yeah, and the Betashares website is a fantastic resource, and I'll show you just real quick for those of you that are very new to this. So if you click on the fund, you can read all about it and what's actually inside it. And if you go, I think it's way down the bottom, Ellie. I'm just going to correct myself here, probably. Now here it is. So you can see all the different types of information that is available, and there's education that you're referring to, plus the resources down the bottom here, like a fact sheet. This is like the brief version of the PDS, and then we've got the full PDS, and it's worth picking it up and looking through it. If you've got one of these ETFs in your portfolio, trust me, you should know what's inside it. It'll give you confidence. There's one other question that came through, if I may just be really quick about this. A lot of people do have a fear that an ETF might close. Can you just describe to us what would happen if an ETF closed?
So if an ETF closed, and there have been, a number of closes of ETFs globally, and since they launched and so on and so forth. So for an ETF manager to want to close an ETF, they have to say this ETF just isn't in demand anymore, basically. So what usually happens is obviously the amount invested in the ETF would drop significantly. Investor numbers in that ETF would be essentially non-existent, and then it would just be communication out to investors who might still be holding that fund, saying, hey, the decision has been made to close this usually, and it's in the best interest of the investor because of the demand or whatever it is, and then money would be returned to that investor based on the latest kind of traded price. So it would close at a certain date, and then the fund gets wound up, and then everything is distributed out to investors. So there'd be no world where an investor, a fund would close and an investor would, where's my money gone type thing, which is also quite a common question we get regarding, hey, what if, an ETF manager goes bust? So we don't actually hold any of the assets. So we've got 30 billion, but that sits in a separate custodian place. So if anything happens to us, investors' money is not affected, which I think is a really important consideration for investors to know. So if Betashares for some, odd reason was to get into strife, investors' money is like completely ring-fenced outside of our business.
Yeah, that's a really good point, kind of like segregated. And that's a really important distinction to understand. And I just wanted to clear that up in this installment of the series, just so people are aware. This has been thought of before, and people have asked the question, and there are protocols in place to protect investors' interests. So, Ali, this has been heaps of fun. I do appreciate you hanging around and answer some questions. I'm still going to be here for 25 minutes, guys, so feel free to keep the questions coming. But I really do appreciate it, and hopefully next time we can catch up, and it'll be like the second time we catch up in 10 years.
Too good. We'll be in the same city next time. We'll try.
Yes, we'll try. We'll do our best. Well, thank you. I appreciate you taking the time to join us.
All right. No, thank you. And thanks everyone who has dialed in. Appreciate it.
Thanks. So that was Ellie from Betashares. Been in the game a long time here in Oz, which is fantastic to have a resource like her that we can call on and pick our brains on some of the matters that relate to not just Betashares but the ETFs in general across the market. So we have time for more questions. I've actually only got 2 more slides or 3 more slides to share with you tonight. So I thought maybe I could just pick up with some of the questions that were sent in. And I can see a few of them. There was a question that came through earlier on And I think that because Ellie made reference to buying gold and buying physical bars of gold. So my iPhone is gold. Not really, it's just the color. But there was a time when people just wanted to buy bars of gold, and they would have to go to the Perth Mint or the mint in your city and pick up a physical bar and go out back and bury it in the ground. I say that with like tongue in cheek, but I still know plenty of investors that do exactly that. I was chatting to someone not too long ago, and he said the only thing that he invests in are gold and silver, and he just buries it in the backyard. And I thought to myself, well, there's an ETF for both of those things. And so nowadays, the easiest way to invest in gold is via an ETF for most people, and financial advisors will do that as well. Because the gold is, as Ellie alluded to, it's kind of like separately identified, meaning that you have like a line of sight to your physical gold bar. You can go on the ETF provider's website and you can check to see, well, hey, there's actually this many gold bars in the vault in London, in wherever, in America, wherever. So that's one of the really efficient ways. I recently spoke to and worked with a fintech in Australia called Rush Gold, which is just an app you can download on your phone, and they go and buy the gold behind the scenes for you, and you can track it in real time, which is really cool. So there's plenty of ways to do that in a digital environment, but ETFs are definitely, I guess, taking off in terms of able to get you exposure to something without all of the, I guess, without all of the rigmarole of actually going down and getting it. So I can see plenty more questions in the back catalogue here. Peter said, why is the tax position uncertain? What happens if there are realizations because the fund shrinks? So that's in regards to Ellie's question about what happens when an ETF closes. So a really easy thing to keep in mind is that when she says the fund shrinks, it's not actually your investment amount that shrinks. What it is, it's just the overall size of the ETF. Let's just say there's 100 of us that have money invested in an ETF, and 60 of us decide to sell out. Suddenly 40 of us left. The 40 that are left still have our original investment, and we would just get a notice to say, hey, this ETF is closing down, you can sell now, or we'll sell it for you and send you the money back. And so that's the big thing that happens when, from a shrinking perspective, the tax that you will receive is the taxable gain, as well as anything that's inside the ETF. So that's a really common question. The big problem that I see with ETFs closing down, and there have been some in Australia, is pretty much that you get your tax crystallized. Like whatever tax gain or tax loss you have, it crystallizes. So that would be one thing that I'd mention. Okay, so there were quite a few other questions which I don't want to miss. One was a really good one from Jason, slightly more technical. If you have the A200 ETF from Betashares, and you wanted to add an extra 100 companies to make it comparable to VAS, the Vanguard ETF, what would be involved? Now, I can tell you from my understanding of this, Jason, that this would be a very, very costly thing to do for not much benefit, because you would have to effectively rewrite the entire legal documentation that you have. So you'd have to reissue the product disclosure statement. You'd have to inform investors and give them due notice, and you'd probably lose some investors just because they don't know what's going on. And you'd also have to pay a new index provider. So one of the things that people don't know is that when you click on an ETF's website, so let's go to, say, Betashares here. When you go to the ETF website, the ETF what you actually buy is just something that tracks an index, right? And so in this instance, we can see that there's an index here that this ETF tracks, the Selective Australia 200. So a lot of people make mistakes when they think about this ETF in particular, being the Australia 200 ETF. A lot of people say it's the ASX 200. It's not. It's the Selective Australia 200 index. Now, if you go inside the ETF and you go into the individual holdings, you'll see that it's basically identical. But the ETF providers, in this case, say Betashares or Vanguard or Global X or State Street, whoever, they have to pay the index provider to construct that index, and they have to pay a licensing fee. So in doing so, what you're suggesting, Jason, they'd have to change so much for probably not that much of a benefit, because there's not that much of a benefit between the 200 and the 300. So Stuart, you said, how does the increasing amount invested in ETFs affect individual companies' ability to raise funds. Do ETFs have different approaches to SPP and the like? That's an exceptional question, Stuart. So this is something that we're going to be debating over the next, I think we'll be debating this over the next 10 to 20 years, maybe only 10 years before it's resolved. But so Solactive is the index provider. That's correct, Paul. Solactive is the index provider. So Stuart, to your question, currently in the United States, I think it's between 40 and 50%, I could be mistaken, of all shares in the United States are held in Vanguard or BlackRock or State Street funds. So what that means is that even though I'll show you how this works with a little Mr. Squiggle. So if we go back here, before I get to that, this will help us all identify exactly how it works. So inside an ETF, just get some colors up. So inside the ETF here, we obviously have all the different shareholdings. So you might have, BHP, Combank, CBA, ANZ, Westpac, Xero, Telstra, Computershare, and you just go on and on and on, right? And each of these different shares will have an AGM. So all of them have an AGM every year. And what we're finding inside this ETF is that increasingly the organizations that have the biggest votes at the annual meetings for things like which director is appointed to the board and how seriously should we take sustainability and climate change, etc. The ETFs, in effect, because they control 40% of all shares, they would, in effect, have 40% of the vote, right? So they have significant influence. And we've seen all of these things, like you as an investor over here, you just own the ETF, right? And inside of that are all the different shares. Now, some investors over here are saying, well, hey, can I go to the AGM and vote? And the answer is you cannot. Even though you technically, inside of your ETF, own BHP, you can't go to the AGM and vote. And so that's important because it means that for people that have a lot of their portfolio, and indeed the whole country, who have a lot of their portfolio invested in ETFs, they have no control over what corporate governance takes place. So what the ETF providers do, in this case, it might be, say, Vanguard, is they use an outsourced vote, like a governance agency. So they will get a company, so Vanguard Voting Intentions, and they have all of these companies that they operate with around the world, and they basically outsource how they'll vote, what they'll do, and how they'll monitor the companies that they're invested in. Now, this is obviously really important stuff, ladies and gentlemen, because this is like our future, and it's really important to understand how and why the companies and the ETF providers make these decisions. And so this looks like a potato. It does look like a potato, but it's actually an ETF. So imagine it's like a basket, Benny. So people are now looking at these organizations saying, hold on a second, you control what all of these companies are doing, in effect, because you control 40 to 50% of all share votes. So, so Taipan, you've said you don't own the shares, you own part of the holder. That's correct. So you own part of the ETF, you don't own part of the shares. But in effect, right, we should, Rob, I just saw your comment. When you own the ETF, you think you own the shares, and at the end of the day, you don't. And so we're going to see increased pressure placed upon these people here for things like climate change and for these types of things. But the ETF provider, i.e. Vanguard, Betashares, has a problem in that they might believe in climate change, but then, this many of their investors might not believe in climate change, so to speak. And so there's a real issue here that we have with who's going to make these decisions and how are things going to get done. And so there are some really interesting global thought leaders on this, like Lawrence Cunningham, who I had the pleasure of interviewing a few months ago. who write about this stuff a lot, and they talk about like what Vanguard and BlackRock and Betashares and all these types of organizations are doing with their money. So I hope that makes sense. But the reason it might sound a bit boring is that at the end of the day, we own the shares. As a country, we own the shares. It's not Vanguard. It's not Betashares. You heard Ellie say this. That money is separate. But it's just that the money is held via an ETF, and an ETF is entitled to vote. So increasingly over the next 10 years, I actually think that we're going to see a big shakeup of what happens here. And currently, my understanding, pardon me, of what the ETF providers will be working on is something like where you can vote in something that the ETF provider sets up for you. You can vote, and then the ETF provider can use that as a way to vote on your behalf. Now, that's in early days, but that concept is probably the solution. So that's something to keep in mind. I just saw Jeremy's name pop up in the chat. He's very late, but he also said he's after a 7-week hiatus. After having a second bub. Kids are the best investment ever. Wow, congrats, Jeremy. Thanks for joining us. You probably got a full plate. So thank you for joining us. Congrats to you. So Space Monkey Mojo, what's the maximum number of ETFs you would hold in a portfolio? I personally think that only 5 to 10 ETFs are enough. I'll get to that in just a second. But I did see a message before about the Rask core service that I run and not having many updates recently. And the reason for that is I haven't had a reason to change. So in an ETF portfolio, I consider, let's just talk about the building blocks. I consider that, say, this proportion could be like Aussie shares, right? Just thinking of a balanced portfolio. This portfolio could be global, just like this. And this could be more of your defensive assets. So this could be more like bonds or what we call fixed interest, or it could be gold and these types of things. Now, to get exposure to these 3 major markets, Australian shares, global shares, and like fixed interest or bonds or gold, you could do that with 3 ETFs. In fact, you could do it with 1 ETF. There are ETFs, diversified ETFs out there that do it in one go. So it's a balance between how many individual ETFs do you want in your portfolio, which gives you more control, versus how easy do you want the admin to be. Now, I'll continue down, and maybe I'll jump past that no, I'll stick with this. So a little while ago, and I think I aired this with you guys last year, maybe the year before on Selfwealth Live, is that in the past, I talked about how my portfolio would change in time. So in the past, like Tom, who was commenting earlier, 100% of my portfolio was individual stocks, like 100% of my portfolio. And now my portfolio currently is about 80%, 80% ETFs or things like ETFs. So very similar to ETFs, like actively managed ETFs, right? So 80%. The other 20% is individual shares. And I probably will see more of that in time. But this is just thinking about my brokerage account, right? Not all of my wealth, because obviously I own shares in my own company and started another company, et cetera, et cetera. So when I look at what it might actually look like in 10 or 20 years, it might look something like this. Like I'd imagine that I'll continue to have investments in private companies. So these are companies that are not on the stock exchange. I'll explain why it's important in a minute. ETFs and funds like this, bonds or like different types of ETFs or funds. So these might be like real estate funds, they might be hedge funds, or these types of things will probably be the yellow. And then finally, I'll have some direct stocks as well. So that might be like BHP or whatever. I don't own BHP, but that's just an example. Now, in the past, it was almost 100% this, right? Whereas now I realize there's benefit to looking at all these other things. And why is this important? Well, it kind of answers the question a bit of like how many Space Monkey Mojo could you have? If you wanted to invest in private companies, or any of us want to invest in private companies, we cannot do that. Just get rid of that stuff. We cannot do this part with ETFs. ETFs are a big no-go there. You cannot do that with ETFs. And in fact, some of this stuff here, you can't do with ETFs. So even though I say like you can build the core building blocks of a portfolio, like you can build a pretty strong foundation in a portfolio, you might not be able to do everything that you want. So, in my opinion, you might have 5 to 10 ETFs, but then you might build on that with either individual shares or some other investment, like property is example. There's no property in this pie chart, right? So you can't put that in an ETF. So that's why I bring that up. Now, there is a good time when you should not be using ETFs. And let me just explain this really quickly. There's a commonly held view that when you're investing in the stock market, there are 3 ways that you can get an advantage over the next investor. There's obviously the behavioral element, and one of the biggest behavioral element that everyone should be focused on right now is long-term investing. If you can outlast your peers in investing, like if you can survive 10 years, I'm confident your investing experience will be very good because so many of us only hold individual shares or maybe even ETFs for months, sometimes weeks. The studies say that the professionals only hold their investments for 6 months. So if you can outlast them in holding shares and ETFs for a long term, you'll probably do better than average. And that's because if you think about it, most businesses don't change that much in 6 months. Yet we try and measure their performance from one 3 month period to the next, which in my opinion is crazy. Anyone that's run a business will know it's very hard to get a lot done in 3 months. So measuring performance over years should be your default stance. This old thing, this is an old piece of wisdom that you used to be able to have um, access to better information. So, like the fastest brokerage account or the best analyst feeds or the newest trading platform or something like that. I don't believe that that's much of an advantage anymore because there's so many fast platforms and everyone's kind of on the same stock market and all that sort of stuff. So this is not as an advantage as it used to be. And finally, analytical advantage. Analytical advantage comes in when you're building a portfolio, whether it's of stocks or ETFs, and you just use your insights. And I'll have a few quotes on that in a minute. But when you use your insights for investing, basically what we're doing is we're just trying to be a bit more shrewd and use data. And it's more important with individual shares, but it's not too important when it comes to ETFs, although we'll cover that in a few weeks. So when do you not use ETFs? If we're thinking of long-term investing, we can't use ETFs in some of the things that are good long-term investments. So some good long-term investments are small caps. So small cap shares are not easily invested in with an ETF. It's possible, but it's not easy. So take, for example, I think it's this ETF off the top of my head. I could be wrong. So this might be an ETF example. I don't know if it's this one for sure, but let me just get it up. So you can invest in smaller companies like those faster growing type smaller companies, and you can do that with an ETF. There are some ETFs that offer it. But one of the problems that happens with small cap ETFs is they can't buy enough of the really small shares because there's just simply not enough shares for them to buy. So they just can't do it. So they end up doing something else, which we call replication, synthetic replication. And so you can't really invest in this. You can't really invest in private companies. You can't really invest in property. I've already said those types of things. So there are some areas where you just simply cannot use an ETF for. There are other things that you might not be able to use ETFs for, like private companies, mentioned that. But also, you probably don't want to use an ETF where you think local knowledge or some type of investing skill will lead to a better return. And some of you have heard me say this before, but that might be like emerging markets. So, for example, if I wanted to invest in India, I wouldn't use an ETF to do that necessarily. I might use it for part of it, but I wouldn't use it for the whole of my investment in India because I think there are some really good fund managers that can work better in places like that than an ETF that just buys the whole market. And there are many other reasons for that, which we can go into in another chat. But needless to say, there are some times when you don't want to use an ETF, but for the most part, for the largest part of a portfolio, this is obviously me, but for the largest part of portfolio, you can build a portfolio very quickly with ETFs and you can get all of the major building blocks, because this is not for everyone, but this is for everyone. Like, everyone can do that. So I hope that makes sense. I went on a long-winded rant there. So there's a good question here. This is an interesting one. Paul, you've got a note here that says you were reading an update from Dave from Strong Money, Dave Gow, who says that he wouldn't invest in property again if he was starting out. Better return from shares. That's an interesting one. So who here, maybe just as I don't know if we have the poll up or not, but who here would prefer to invest in property? So just investing, not living in it. Who would prefer to invest in property versus shares? You can even just comment it in the chat. Like, what would be, show of hands, please? What would you prefer? And imagine that you already live in a house. So there's no, like, you don't need to like save up and buy one, but who would do that? And I can see Rob's currently got a poll up. It says, how long have you held your longest ETF investment? Oh, Rob, that's for years, many years. A lot of people have said 2 to 5 years, which is great. 73% of people have said 2 to 5 years. So Jason, you've said 10 years ago you would have invested in property, but now ETFs. Stewart shares, Danica shares, Raya shares. Can't sell a room on the house, says Mr. Morkra. So can sell shares. Shares. Well, we're all probably a bit biased, let's be honest, because some people do love property. But I've got to admit, like, what I do tend to see, and I talked about this today with Jamie and Drew for the Australian Shareholders Association, is a lot of people do start with property and they just completely flip. Once they've built some wealth, they start to sell down their property portfolio and then migrate it to shares. And that's a really common thing. Because people realize they can use leverage on a property to buy property and then it goes up, hopefully. But they can't really do the same thing with shares. So they basically get more buying power when they can afford to take the risk, and then they slowly transition back across in a safe way. That's a really good point you make there, Martin. You get less stress with property as it is not publicly valued every day. Both shares and property. Chris, I'm glad you said that. You've said both shares and property. Why make us choose? Good point. Hammer, you've said can sell tomorrow to release funds in shares. House can take weeks, if not months. That's true. Liquidity. This is an interesting point. The ability to buy and sell shares is both a blessing and a curse, because people then tend to overtrade or buy and sell too much. Whereas people know how expensive and how hard it is to get in and out of a property, so they tend to stay with it for years. My colleague, co-host Chris Bates, who's a mortgage broker from Sydney, he always says that, like, whenever you get stuck up in this stuff, you get caught up in it, just remember to focus on 5 or 10 years from now. So that's one. Chop, how did Owen explain not to buy ETFs regarding liquidity? I can explain that really quickly. So why don't I'll get out Dr. Squiggle again. So this is, you guys just hate me for getting this thing out. You must be like, oh, here he goes again. So I'm going to show you how ETF liquidity works and why it doesn't always work for small caps or these types of things. So typically, let's do the potato that Benny was interested in. So here we've got you, the investor, and you invest in the ETF. Now, when you see the ETF and you look at it in your brokerage account, when you look at it inside Selfwealth, let's just get this back up. I don't know if I have this in the test account. If I can bring this up. There we go. Logging in all this extra security I've got these days. So if we go into, say, like the VAS ETF, you can see what people are willing to buy an ETF for and what they're willing to sell it for. And you can see how many shares traded, and you can see what the closed at, and so on and so forth. Now let's use another example. Let's go with food. That's a new one from Betashares. So here we can see what the latest bid to buy the shares is. We can see what the latest offer is to sell. So there's a bit of a distance between those two. You can see how many units changed hands and the closing price at the end of the day. Now, what these things are, the bid and the offer, and what this is, this volume, this is showing you this stuff right here. This is showing you the bid and basically the offer. So the offer to sell. So that's basically what we call the spread. The distance between these two prices is called the spread. Now, this is the first form of liquidity, right? This is the first form of liquidity. So when I was talking about liquidity before, I'm not talking about this. So if you have a small cap ETF like the VSO one from Vanguard, this is no problem. That will happen. It's not that liquidity that I'm referring to. It's what happens after that. So when you buy into the ETF then has to go and buy all of the different shares that are available for that ETF, right? And it packages them all up, and then those are delivered back to the ETF provider. Now, who does this? There's typically a market maker on the other side. So, market maker on the other side that does this. The problem is, this is the second form of liquidity, right? So, this is the second form. This is the thing that no one understands. Well, few people understand, really. This is the risk to ETFs, is that if you buy into an ETF, and that ETF, when you make a purchase, cannot go and get all of the individual shares, they can't be passed back to the ETF provider and passed back to you. So there's what we like that would cause friction in the system. It will happen, and during times of like a market crash, it happens, and ETFs survive. But it's not designed to invest in something like over here that's not easily bought and sold. So this is a second form of liquidity. Most of the ETFs that you see in Australia are good here and good here. So you've got nothing to worry about. But for example, someone made a joke before about you can't sell the bathroom. So if this was a property ETF, if this was Jeff's property, I don't know who said the comment before, but if this was the property ETF, you can't just go, okay, we'll just take the bathroom off and we'll put that inside the ETF and presto, and then we'll take that part of the ETF and send it back to Owen, who's the investor down here. It just doesn't work that way. So that's why you can't have a true property ETF, because you can't find the bits to buy and sell. That's as simple as it is. And so there are some things where, if you think about it, if we go back here, if this is your advantage, if your information is your advantage, and you want to invest in small cap shares where no one really knows about them because they're small, you shouldn't be using an ETF for that. You should be looking, I think, at other alternatives like managed funds or buying the shares yourself if you're really risk seeking, and so on and so forth. So is there a difference between Dr. Squiggle and Mr. Squiggle? Says Jeremy. Jeremy, you've tuned in a bit late, so I'll forgive you for this. There is not a difference. It just depends what I'm up to that day. Benny, just saw your comment. Best to invest in shares and property, says Verghese. Yeah, so Taipanya said, I was in real estate. I would rather property, but it depends on the market and leverage. Yep, fair enough. Okay, so how are the high stakes and low tofus portfolios going? Okay, last thing I do before I give you the quotes for this evening. Let's see if I've got this in the Selfwealth Live sheet. This could be revealing. Here we go, guys. Ladies and gentlemen, here we go. We've got the high stakes and low tofu portfolio. So these are the portfolios we started to build. What is what is it at now? So that's the stock market has returned 5.26%. Is that, yep? And the low tofu is 4.77, and the high stakes is 4.84. But obviously there are some weirdness in this data. Remember that this thing doesn't change, and this thing doesn't change, and also there's no dividends included in these stock returns. So I'm actually, given all of that, I'm actually quite happy that they're about the market return over a short period of time. So when we made this first investment was January 31st, 2022. Actually went for an ultrasound yesterday and they use Nanosonic software technology. So I'm actually quite happy with this. Quite happy with this return so far. There you go. There you go, Paul. So that's the portfolio right there. Jason, BHP. Yeah, there was the split with BHP in here, which we couldn't adjust for in the numbers. So we couldn't adjust for that in our performance reporting. And there were a few other things in here, but like what's the Femex ETF at now? I don't even think we can get that up on the ASX. I think we can get it on the ASX website. nowhere else. Let's have a look at that one. So what are we at? Come on, Femex. It's at $6.14. So I could update that one. $6.14. MGOC. MGOC. Let's see if we got this. $2.63. So $2.63. I think there are a lot of others that are out of whack in here, but okay, now you can see now that we've updated those prices, we're outperforming the market. Look at that. There we go. Remember, guys, show these results. 2 years is very short term. So in my opinion, if you want to invest in high quality businesses, it takes 5+ years. Okay, final thing from me for tonight. I've got some slides. We're going to be back next week with another expert guest from Betashares. So stay tuned. We're going to be talking about much more than just what I've been answering tonight. So, okay. The best way to minimize risk is to think. So I wanted to underline that. I learned to study history better. And Thomas Gaynor says a lot of financial history. I read a lot of financial history and studied human nature. So I think if a lot of us just stop and thought about what we're doing in investing, we studied the past to have an understanding of what happens in the future, and we identify with human nature. I think those are like superpowers for investing. And here are 3 of the world's best investors saying this. So we've got just to think about what is happening, to study history, and to identify with human nature. Like if you think about this is really all there is to investing. If you just think about the businesses that are changing the world, the history, have we been here before? Market crashes, bubbles, all that sort of stuff. Yes, probably. And human nature. Like a lot of us get sucked into various schemes and plots when it comes to investing, and so many of them lead us astray. That's all I've got for tonight, guys. We will be back next week. We've got is it David Bassanese? We have Cameron Gleason and so many others coming up over the next few weeks. So I did see Vegas' point here about Moat. Where is Moat? Moat is up 16%. I'll take that. So we're going to keep building on this knowledge of ETFs. There is also the giveaway. If you look in the video description down below, remember all you've got to do is 2 things. Number 1, put in your email address and tell them like what you like about ETFs. That's the number 1 thing. Number 2, be a Selfwealth customer. There's literally the 2 things you have to do to enter the draw. I think it's a $6,000 giveaway. I'm hoping Rob will paste a link in the chat. At the end of this session, go in there, put the information in. It takes 2 seconds, and you go in the draw to win up to $6,000 in prizes. Pretty good for not much at all. Thank you, everyone who joined us tonight. Thanks, Stuart. Thanks, Jaden, Danica, Maddie, Paul. We'll be back next week. And thank you, Rob, for dropping that link in the chat. $2,000 prizes up for grabs, and there's 3 of them. So that's it for me for tonight. I think I'm going to hit the pub, actually. I'm going to go over to the pub, maybe grab myself a Palmer because I'm in Melbourne. Not a Palmy, a Palmer. Thank you very much. More like Peelborough. I'm going to have a Palmer here in Melbourne. So I hope you all have a wonderful evening. Thank you for joining us. We'll be back next week, same time, same place, nearly the same place, 6 p.m. Selfwealth Live.